Thank you, Peter. I stand before you as a fine example of an older guy. I'm not sure about the wisdom. The middle spreads and you deceive yourself, it's wisdom. Peter's asked me to talk at a little higher level on some themes for the conference here to give it some framework, I guess. So this is sort of Cloud 9, and hope you don't wander off to Cloud 13. The conference is about forecasting, about valuation, and of course the role of financial statement analysis, and we might indeed add risk. And I have a very simple message here that's in the paper I gave you. I'm just going to touch on a few of the ideas here. Forecasting, valuation, indeed risk is a matter of accounting. Now there's your one-liner of accounting for the future. But the idea I think comes across from Keith's presentation that when you think about how your company's going to evolve, you think about what the balance sheet, the income statement's going to look like. What's he call it? He calls it the growth playbook. And indeed, the idea here is that all forecasting needs to be done, at least for valuation, needs to be done in an accounting framework. It provides a discipline. It provides a check on speculation. By the way, I'm sure you were impressed as I was with Keith's presentation. I had talked to him before class, and he went to Columbia back in the early 90s, I guess, 91. Now, for those of us who labour in the MBA classroom, sometimes we wonder what effect we have where the light's going on. It turns out Keith, a mathematician, got a tremendous amount from his MBA education. Attributes a lot to where he's now to his MBA education. So maybe Keith's just a tail event, okay? But there you have it. We actually add some value, I think. Okay. Valuation. Let's just get in mind how we do valuation. Let's talk about a one-period payoff. We always say that value is based on the expected cash flow, X here, okay? It's really based on consumption, but cash buys consumption. And we can think about it in terms of an expectation discounted for risk in the numerator, or as we teach in the MBA class, it's a discount in the denominator. The second form of it here, this is just a one-period payoff. The second, both these are equivalent for a one-period payoff, but multi-period, the second one doesn't really quite work. The first one's appropriate, and I just mentioned that because I want to come back to that point a little later. But two aspects in valuation: forecasting and discounting for risk. 2 points to the paper here. Again, elaborating, forecasting is really primarily, first and foremost, it's a matter of accounting. Indeed, a more subtle point, I'm not sure I'm going to cover this entirely, that risk actually is a matter of accounting. The way we do accounting builds in risk. The first we often refer to as a numerator issue, and the other denominator issue. Numerator issue is typically what we get involved in as accountants who work in valuation. We leave the denominator to our finance colleagues, but one point I want to make that actually the denominator is very much an accounting issue also. There are 3 features of accounting that link forecasting, link accounting to valuation. These are very familiar to us all. These are just accounting properties. First of all, that should express X, the cash flow, in terms of earnings and changes in book value. That's just the clean surplus relation. So to equivalently forecasting cash flows, we can equivalently forecast earnings and book values. The second is that overall periods, this is a little bit rough here, overall periods, the sum of earnings equals the sum of the cash flows, and what accounting does is merely allocate to periods. Okay? Just note that because that's going to be important that when we come to forecasting, the transition from the present to the future has to do with how we do our accounting. It's the allocation. And the third thing is that the summary numbers, the balance sheet summary number, book value, and the income statement summary number earnings is based upon components which aggregate in a very definite structural form, and when we come to forecasting, we want to make sure we employ that structural form. These components connect us to the business, but they also give us an integrity that must be maintained. You can't forecast outside of the bounds of these structural relations in the accounting system. I'm just going to elaborate on these points. Okay, run through Valuation 101. We forecast, let's think about equity valuation. Forecast dividends. We don't want to do that. Cisco doesn't pay dividends, so it sort of doesn't work. So we say, look, let's forecast earnings and book value, and we come to our residual earnings model, okay? Very standard, and of course this just represents that we can think about valuation about being where the book value is now, and then we can think about the extra value as the earnings that have not yet been booked to book value, okay? And the model's written down here as an infinite horizon model because these are going concerns. But the point to write it down here is that the accounting is not just the information we supply to forecast future cash flows. As the standard setters lay out in their objectives, accounting is about providing information to forecast cash flows. No, it's actually also about supplying the target, what you want to forecast. And actually primarily that. We don't want to forecast dividends because a lot of firms don't pay forecast dividends. We might forecast the dividends of GE because up to a couple of years ago when they dropped the dividend, it's very readily forecastable. But we understand from our valuation theory that forecasting dividends don't really give you much. Very predictable. What you need is accounting. For finite horizons, it doesn't matter, of course, because you close your books, you just get back to cash. But for practical finite horizon forecasting, he talks about 3 years, okay, which is basically most we can do in a practical point of view for most businesses. The accounting matters. And so when you think about forecasting valuation, the first thing that comes to mind, in my mind, is you think about how I'm going to do the accounting. Do I want GAAP accounting? Do I want IFRS? Or do I want something different? Now, the General Electric, I think, Keith, I implied this, when you do your internal work, you use certain metrics to get insights into the business, to do your forecasting. And at the end, for compliance reasons, you repackage it, a lot of work repackages into GAAP for dumping it out. Well, the question is where you lose information there, that actually the other accounting might be better accounting. So I guess the theme here is when we think about valuation, let's think first of all, how are we going to do our accounting? We could have fair value accounting, or we could have historical cost accounting. Foremost, it's not a question of predicting GAAP earnings. It's really a question about how you're going to do your accounting. So that really, I think, really marries accounting standards setting to valuation. And one way to think about accounting standard setting is how do I want to my accounting to look like for valuations? I just don't want information that forecasts cash flows. I want information which I can actually, I want a structure which I can latch onto to set the target for the forecasting. And just to elaborate here, let's think about finite horizon forecasting. With a dividend discount model, the no arbitrage relation just says price is the present value of dividend and a terminal, where's my red? There, a terminal payoff, okay? This is no good to us because we don't know the terminal price, but in an accounting setting, it's book value, the present value of earnings relative to book value up to horizon, and of course you've got this end thing which you call here the continuing value in a valuation, okay? In some sense you can see that this final premium, price over book value, is really error in the accounting system at that point T. Let's not think about finite horizon forecasting. In the long run, we're all dead. Forecasting 10 years ahead, 11 years ahead. Maybe for the aircraft engine business, there's something to it. But in most cases, it gives me serious psychological problems. I want to really think about latching onto value in terms of forecasting 3 years, 5 years, and that really is my problem here, the accounting system. In the accounting system, to what extent do I have a remaining error? If in fact this goes to 0, of course, I'm done. After 5 years, I've got no error. But otherwise, I do have error. That, of course, is not the end of the story because there's also an income statement. There's error in the balance sheet, and it's well to keep in mind that error in the balance sheet is not an agreement that error in valuations are based on accounting, but it's not the final say because there's also an income statement. This is the sort of the fallacy of if you don't have fair value balance sheets, you don't have intangible assets in the balance sheet, the accounting sometimes somehow screwed up. It turns out it's not correct because we understand that given the clean surplus relation, you can express the stock returns in terms of earnings and changes in the premiums, and for the changes in the premiums, that is this here is 0. Of course, earnings give you the plug. The income statement gives you the plug. Of course, this is the notion that it doesn't matter if there's no intangible assets on the balance sheet. If you're getting the earnings coming from Coca-Cola through the income statement, you've got the valuation. You don't need it in the balance sheet. And so one thing important to think about in terms of accounting, it's not just error in the balance sheet, it's error, because error in the balance sheets cancel. Accounting-based valuation tolerates error in the balance sheet up to the point which they cancel, and the only problem is they don't cancel. And so that if there's error in the balance sheet, we can still get the valuation, the P here from the terminal earnings. So in our valuation, it's a question of, what's the balance sheet error at the after 4 or 5 years in terms of modelling our future financial balance sheet, but then also the error in the income statement, and that defines your error from the accounting system. Okay, now what are the implications of this? Well, I've just said the first one. Omissions from the balance sheet are not necessarily error. This is also an income statement. They work together, and when we do forecasting, we've got to work with income statements and balance sheets together, because that's just a double entry, okay? They go together. Forecasting error is not merely error in a given forecasting technique. When we come to valuation, valuation as error is also from the accounting used in the valuation. So we've got to think about, for example, and in this case, so relevance and reliability sort of fall in place together. So we can think about dividends, for example, under point 2 there. Dividends are easy to forecast. We make elaborate, and cash flows may be easy to forecast, elaborate procedures to forecast, fancy econometrics, okay? But it really doesn't get us anywhere. The fact that we can forecast GE's dividend next quarter or even over the next few years fairly accurately doesn't really help us a lot, okay? It's a question of getting the accounting right. Correspondingly, we can think about the overall problem as being accounting, relevance and reliability. So, for example, the easy way to approach this would say, hey, if I want accounting where price is equal to book value, okay, fair value accounting, let's call it. And I could sort of put in level 3 fair value junk into the balance sheet, okay? But then I'm doing something, I sort of have no error in the balance sheet. But ultimately, of course, it's error in valuation. How am I wrong in terms of where I'm going to end up 3 years hence in terms of my valuation error? And that sort of brings the relevance and the reliability together. How do we best design? So in some sense, forecasting, first of all, is a matter of accounting design, because forecasting is accounting for the future. That's my little theme, okay? Feature 2, accounting merely allocates to periods, so that the point here is that the transition between the present and the future is a matter of accounting. That really determines, if you want to estimate forecasting models, that really determines the parameters of the model. Okay? It's accounting that determines the parameters. It's not, first and foremost, it's not a statistical issue. It's an accounting issue. So let's say we just dealt with the summary numbers, no line items, forecast future earnings with current earnings and book values. You've got to have the dividends, of course, because they displace earnings. If in fact you can have beta 1 equal to 0, beta 2 equal that's a fair value accounting model, okay? But if in fact you have a historical cost model, you're going to shift weight to beta 1, and the way you shift the weight to beta 1 depends upon the accounting you employ. So it's important to keep that in mind when we forecast earnings, that in fact it's a property of the accounting principles. It's fairly obvious, right? And the general case, of course, is the Olson model, where the beta 1 and beta 2 are based on a weighted average of earnings and book values, which is M&M consistent, dividend irrelevant consistent. But the point to keep in mind, I'm just laying out some ideas here, is forecasting is a matter of accounting. Did I have some implications? Well, some implications here would be, of course, that if you're forecasting earnings, you really want to break down those earnings and using the book values in terms of the type of accounting. We're clear, if you're forecasting fair value earnings, it's very different from forecasting historical cost earnings. The transition parameters are very different in terms of the relative betas here. And to forecast earnings and not decomposed earnings into terms of the line items, which is subject to different accounting, you're going to get too much aggregation, and you're not going to take into account the accounting which is employed. Okay, the final feature, third feature, is that accounting has a particular structure. That assets have to equal, equity has to equal assets minus liability, earnings are revenues minus expenses, and earnings are also changes in assets minus changes in liabilities. This has to cohere. This has to be an aggregation from the line items, which is a fixed structure, a deterministic structure, an immutable structure, and that governs your forecast. And that's, in terms of forecasting, we can't go outside the bounds of that structure. The accounting provides a discipline, okay? You can't have forecasts from an econometric model or a statistical model which actually goes out of the bounds of what reasonable balance sheets and income statements are going to look like. And you can't have forecasts of components that aggregate to the whole. That discipline speculation, forecasting, accounting framework is a very good basis for disciplining the speculation. You can't go outside these bounds of these structural relations in the accounting. And it's a check on a statistical forecast. Yeah, it's very easy to predict earnings in sample, estimate parameters, go out of sample, things work a lot worse, maybe because you're not disaggregating for the accounting, but you come up with a forecast which, when you run through accounting, these cannot be tolerated within the accounting system. It's out of bounds. So the accounting system disciplines your forecasting. It's not a matter of statistics primarily. It's a matter of accounting. The fact that earnings are based upon all sorts of components is important for the forecasting. And the historical example here is the old fellows remember this one. 1972 is a paper by Ball and Watts. Earnings follow a martingale, okay? And you can't do any better than martingale. Those are the days when we first got computers, we could do box junctions and that sort of thing, okay? It's a martingale. Well, and you sort of run it, and this paper by Leftwich and others to show you, no, it's basically a martingale. If you fit the statistics, it looks like a martingale. Well, something I realized, and this is really sort of the beginning of financial statement analysis, when you expand the line items, that is, if you limit yourself to a time series of just one information variable, you're not going to do very, very well. If you start to expand the information set in the accounting system according to the dictates of the accounting structure, you do very much better. And the paper I learned this on was Freeman, Olson, and Penman, 1982, where it said you just bring in one piece of information, book value, it's easy to show that earnings don't follow a random walk. Okay? When ROEs are high, they're likely to be lower in the future. And when they're low, they're likely to be higher. And then you can run through and expand the line items. And that's really financial statement analysis, is looking at the line items. How do you employ them in forecasting? Again, governed by the structure that the line items must work in a consistent way relative to each other, and that gives you a discipline. The accounting framework is a forecasting framework. And of course, the components then linked to value. Given this is somewhat an overview, I've indicated some authors on the program who I think are going to talk about this. The accounting's got to connect to the business. And I think Penman's going to talk about that, and the components do that. Gives you the means of connecting to the business. Again, as Keith talked about, it's all about scenario analysis, downside, upside, maybe more scenarios, maybe tail scenarios. Accounting's a framework. You model income statement and balance sheets under different alternatives. That keeps you disciplined. You can actually model extreme scenarios, those you've never seen before. What if, okay? What if we have this crisis? What if we have run liquidity? What is the second order effect? No, let's not just look at the financial engineering for credit default swaps. Let's look at the effect on AIG in income statement and balance sheet framework when you start to get second and third order effects, liquidity effects, your trading partners going away, all within an income statement and balance sheet framework. You actually can model. You can model the scenarios, the effect on the firm as a whole within an accounting framework. Okay, my last point is risk. That's the so-called denominator issue. And typically we hand this over to the finance people. The students come into my financial statement analysis and valuation course, and typically I've said, well, this is cost of capital problem. Not my job, not my course. You get this from finance. Run out your CAPM if you want to, okay? And I say that sort of very doubtfully because this CAPM's all playing with mirrors, right? And this Farmer and French is all playing with mirrors. It's a question ultimately, you know, can we actually bring the accounting to this in terms of dealing with risk? In finance, say the CAPM, the thing you want to focus on is beta, which is basically correlation of price changes with an overall market-wide factor. In accounting-based valuation, we see, hey, what's risk? What risk is? There's fundamentals at risk, and that's, of course, our income statements and balance sheets. It's modelling how they're at risk. What's it going to look like 3 years hence at General Electric or anywhere else, and what's going to be the dispersion about that? What are the likely sets of balance sheets? And so we can think about risk in terms of this. And ultimately, when you think about that, forecasting is actually error introduced by the accounting you do. It actually comes down to the distribution of forecasting error giving the accounting you're employing. With that, and this is just throwing a few things out now, this is not tidy, this is not put down, but I just want to raise in your mind, as we think about this conference for future research, that you really think about risk, given about an accounting issue, given, of course, that asset pricing in finance is total chaos, okay? They haven't got it. And so they think about covariances, and the alternative, of course, is to think about cash flow betas. It's your earnings that are at risk. They call them cash flow betas, but they're actually earnings betas, okay? The ROE betas got the book value in there appropriately also, okay? And Penman has a paper in the Accounting Review, 2008, that introduces these cash flow betas or earnings betas, fundamental betas, okay? Now, is this a good way to go? Well, again, it all depends how you do your accounting. There's only two cases where a cash flow beta works, okay? That is pure mark-to-market accounting. I mean, not very fair value accounting, pure mark-to-market accounting, and what we call permanent incomes accounting, okay? That's accounting error in the balance sheet concept notion. That works, okay? Because in that case, earnings equal returns, fundamental returns, okay? It works. And in another case, it does not work perfectly. And you can see that from that point of view, you can see when, in fact, let's say the market goes up, okay? You have good times, and you're a firm which invests in assets for which you have conservative accounting, R&D, okay? And that's the scenario. Times are up, we invest more, right, in R&D. What happens to your earnings? Under GAAP, the earnings go down. So yes, the market goes down, but your earnings, market goes up, but your earnings go down because of the accounting. The cash flow beta is not going to capture it. It doesn't really capture the R&D at risk. It doesn't. It's perverse because of the accounting. And so if we want to think about now risk from an accounting point of view, we've really got to think about how the accounting is employed. And that introduces another feature that I'd like you to think about. That is that we mentioned the word conservative accounting, and that always a student, that always, to me, it sort of triggered the notion, well, we're conservative here because we're worried about risk, okay? Conservatism and risk go hand in hand. And here's a fourth feature of accounting that's relevant to forecasting and valuation, is that what accounting does, GAAP accounting does it, fair value accounting will not do it, but GAAP accounting does it, is it defers income under uncertainty. That is, we say to the students, hey, you can't book the income till you get a customer. Or if you want to put it another way, in asset pricing terms, you can't really book income until you get a low beta asset, cash or receivable. Okay? We know what conservative accounting does. It actually depresses earnings now and gives you more earnings later. And if you've got R&D, which is very risky, okay, you actually write off the balance sheet and really damage earnings now and give you a lot of earnings growth. And so one thing you might want to think about in terms of correcting these cash flow betas, or, here's an objective for us, building an accounting-based asset pricing model that's consistent with accounting-based valuation that recognizes the accounting and replaces the finance asset pricing models, is to think about conservative accounting being employed in risk and creating growth. That is, growth is risky. And that's just the notion is, I buy short-term earnings, and that's at risk, but I also buy long-term earnings. They're at risk also, and that's embedded in the accounting. And just to give you some taste for this, this is my final slide, bar one, I think. I'll let you stare at this. I'll give you the guide to this. Rank on earnings to price, rank on book to price, okay? Track the turns. This is value versus growth strategy, as they would call it, okay? You see the returns are spread on earnings to price and book to price. If, in fact, your conservative accounting depresses earnings relative to book value, we know that conservative accounting gives you a lower book rate of return now and a higher growth. These are the returns you'd expect to get if the accounting was actually capturing risk. Now, I can't explain that. I haven't got time. But I'll give you that tidbit, okay? This is trolled many times by value growth investors. But actually, you can explain these returns as returns to risk, where accounting is employed such that conservative accounting captures risk and gives you growth. Now, that is just a soundbite. I haven't explained it. I'll leave it with you. But I would say, well, just want to do this. One thing that's encouraging is, hey, in accounting-based valuation, there's very important denominator issues, which are not solved in finance. It's all playing with mirrors, this Farmer and French, and even the cap here. We have a challenge of developing an accounting approach to it.
Two questions.
Two questions.